Hey guys, welcome back to the channel. I did some reconnaissance, some field research, some due diligence this week on a stock that I have actually added to the portfolio. And the field research is represented by what's in this bowl here. So we're going to unveil what's in this bowl that I've invested money in this week. And if Santa brings me cash, I will probably buy some more. But before we get into that, we're going to look at the performance of the portfolio. So stay tuned. Hey guys, Kevin Burgess back again with another dividend stock video. If you are not familiar with this channel, what we talk about are dividend stocks. We talk about the companies behind the stocks. We invest in stocks that we like the company, we like their strategy, we like their management, we like their numbers. So we really dig deep inside these companies before we decide to buy. And I tell you, this week I've bought into a new company in the portfolio. As you know, one of my goals has been to reduce the number of stocks in my portfolio. But hey, sometimes you just can't help it. You have to buy another one. This week, I've added a stock. I'll share with you what that is. But let's take a look at my portfolio, the performance for the week, where we are compared to SCHD, and then we will get into the meat of this new stock. So as you can see on the screen here, we have the portfolio's total return. Now, for 1 week, we increased the portfolio by 0.42%. SCHD, however, beat us again this week by just a small number, but it's still, still a win for them. They came in at 0.53. For the month, they have outpaced us 5.3% for our portfolio and 7.1% for SCHD. However, it's been a long time coming because in the 3-month period, we're still outpacing SCHD. We are producing a 9% return in the portfolio versus 7.5% for SCHD. We are looking at a year-to-date performance so far of 16.7% versus 4.18% for SCHD. And then the year, it's getting actually pretty close to the end of the year, so these numbers are converging. And we're looking at a 17.31% return for the last 12 months versus 4.81% return for SCHD. So still very pleased with the performance of the portfolio. Here the last month, we've struggled a little bit compared to SCHD. But you know what? A 5% return in a month is not that bad. If we got 5% every month for an entire year, that would be a 60% return, and I would take that. So 5% is really good, 7% is better, but hey, it's good to have a benchmark. It's good to have something that pushes us to get better and better, and to really make sure we understand what's in our portfolio. So that's the update on the overall portfolio. Let's take a look at the top performers and the worst performers for the week. Here they are. RTX Corp was the top performer, and tied with it was CME Group. So both of those I have done videos on recently. They increased by 3.67%. Fidelity National Financial went up 3.3%. Digital Realty Trust, one of the 2 REITs that I have in my portfolio, was up 2.23%. And Hess Midstream, if you're not familiar with it, is a midstream oil and gas company. It is really a spinoff from Hess Petroleum. Now, I've covered Hess before in these videos, but I also have mentioned it in my Instagram account. If you don't follow me on Instagram, maybe you would consider that, because that is where, when there's something really quick that I need to get out, that I want to make sure that people are aware of, that's where I do it. I don't update a lot there because I don't want it to be a place where you go, oh, he's updating every day, every week. No, when there's something that's serious that I want to update you on, that's where I put it. When I look at the worst performers, I've got Pinnacle West Capital Corp It's a utility out of Arizona. They were down about 3.5%. U.S. Bancorp, which has really been on a tear lately, was down about 3.3%. Cummins CMI was down 1.9%. They got some bad news this week about a settlement with the government for about $2 billion with a B. Lowe's, it was down about 1.15%, and Altria Group was down about 1%. So those were the top performers and the worst performers in the portfolio this week. Now, without further ado, let's get into this newest acquisition in the portfolio. I think of it as a new team member who's going to join our team, make our team stronger, and help us win in this battle for wealth and passive income. So this latest acquisition, it has iconic brands and a wide moat. It is a consistent grower of revenues. It has a consistent growth in earnings as well as free cash flow. It has a high return on invested capital. It's got a manageable debt level with a very high interest coverage ratio. And then lastly, it's trading at a slight discount. And the last time it traded at a slight discount was 2020. So I'm really pleased to be able to buy into this new position in my portfolio, which is Hershey's. Hershey's chocolates. I love chocolate. I'm really glad to finally be a shareholder in Hershey's. So those of you who know me know that I really dig deep into a company. I look at their financials, I look at their capital allocation, I look at their valuation, I look at their strategy, and I look at their management team. Those are the 5 things that I really delve into. And I'll tell you, Hershey's is really knocking it out of the park. So I'm really glad that the price of Hershey's has come down. So let's take a look at some of the things that I looked at deciding to buy into Hershey's this week. So let's take a look at what's in this bowl right here. Hershey's has a lot of different brands that I didn't know about. So I basically went through a major retailer. I won't say who it was. Went through a major retailer and started looking at all the candy bars. And, lo and behold, I didn't realize Almond Joy, Peter Paul used to make this. It is now owned by Hershey's. Almond Joy's got nuts, but Mounds don't. Mounds is also part of Hershey's. And who can think of Hershey's without thinking of the iconic Hershey's bar? I mean, that's really a good treat. They also, I did not realize this, make York peppermint patties. Now, I love these. It's just something about that mint with the chocolate. Oh, I love that. They also make Reese's, however you say it, peanut butter cups. Now, part of innovation we'll talk about later is Reese's has Christmas trees. See that Christmas tree? Reese's also has Santa Claus. Check out that cute little Santa Claus. It's got bells for Christmas. So they've got all kinds of innovation along those lines. Guess what else Hershey's makes? They make Kit Kat bars. Who doesn't love a good Kit Kat bar? And then I'll share a couple of other things in here. But you can tell I've got a whole bowl full of chocolate. And my mouth is watering. So I might actually eat one of these on the video. But, we've got the Hershey's bar. We've got dark chocolate. My wife loves the special dark. We've got all kinds of, and who can forget the iconic Hershey's Kiss? So I'll leave it at that, but you see all of the products and all of they call it confectionery, all of the confectionaries that Hershey's has to offer to its customers. So now that we talked about the iconic brands, let's talk about some of the financial numbers. Their total sales have grown consistently up and to the right. Look at their operating margins, consistently above 20%. Their net debt to capital had grown and is now down around 55%. So that's very manageable. And also their interest coverage ratio is around 16. And that is really good. We want anything that is above 8. Let's take a look at their earnings payout ratio when think of capital allocation. This is how they allocate capital to dividends. And they are somewhere in the mid 40s range. It looks like it may bump up to around 50% in the next 12 months. The free cash flow payout ratio is very manageable, down around the mid 40s to looks like mid 50s maybe. And they've invested a lot of capital in the past 12 months, which is what's driving that free cash flow payout ratio a little bit higher than it has been historically, but that is nothing to be alarmed about. Their return on invested capital is tremendous at 27%. And Simply Safe Dividend says that their dividend safety rating is a 93, which is very safe. Dividend growth, let's look at the last 5 years. Their last 5 years of dividend growth has averaged 9% per year. That is really nice. They have a 13-year dividend growth streak with a 34-year uninterrupted dividend streak. Let's take a look at their valuation. According to Morningstar, they are 7% discount. They say their fair value is around 197. They closed yesterday at 182.52. They have a wide economic moat with a standard, which is kind of an average capital allocation rating. According to Simply Safe Dividends, their forward PE ratio is about 18.6, which is much lower than their 5-year average, as well as their dividend yield being at 2.6, well above its 5-year average of 2.03. So whether we're looking at Morningstar, whether we're looking at Simply Safe Dividends with its PE ratio and its dividend yield, it looks like Hershey's is in at least a fair value range. Let's take a look at the stock price, and you can see that over the past year, Hershey's has dropped a little over 20%. Now, that's a significant drop. So as dividend growth investors, we don't look at what a stock price is and go, wow, they've dropped 21%, so it is cheap. We have to ask ourselves the question, why did it drop? We want to understand why it dropped. We want to understand if management can overcome those issues. And if so, maybe the market has it wrong. And those are the stocks we're looking for. So let's ask that question. Why is Hershey's stock price declining? Well, a couple of things that I found out. They have some near-term threats. One of those is that their inputs, which are cocoa, sugar, and labor, are rising. So the cost of making their products is going up. Inflation is driving lower income consumers to make trade-offs at the grocery store. And one of the things they said on their earnings call was sometimes the lower income consumers have to decide on things that are going to fill them up versus things that are going to be like a confectionery or candy. And another thing, which is kind of interesting, online shopping apps are reducing their impulse buys at the checkout counter. So if you think about that, it kind of makes sense. I mean, if people are shopping online and they're having their groceries delivered to them in the car, they're not walking through the store, they're not walking through the checkout counter with all of those candy bars on either side of them and picking up a candy bar and throwing it in the basket. Longer term threats, we have consumers are trending more toward health conscious items. Some are saying that there's an impact to all of these weight loss drugs on consumer choices. We will have to wait and see on that. I'm not really sure that is true, but it is something that comes up in the research that I did. And then lastly, confectionery innovation is difficult. I mean, I don't have one of the original Reese's peanut butter cups. You know what those look like, but innovation could be making it into a tree. It can be making it into a bell. It can be making it into a Santa Claus. But the taste is what brings people back. It's really not the shape. It's not the packaging. It is the taste. So then the next logical question is, can Hershey's management address these threats? Can they bridge the gap between what they're finding in the marketplace versus growing their earnings, growing their business in the longer term? So here's what I found out. Economies of scale help reduce input prices. So, I mean, they are really big, right? They are 45% of the U.S. chocolate market is Hershey's. So they've got a big footprint. They've got a lot of economies of scale, and that, I believe, will help them stem the tide of higher input prices. Inflation seems to be reducing, and while the higher prices are probably here to stay, at least the future is more manageable. They can also increase prices if necessary. They did that at the end of last year. They did not say they are planning to do that anytime soon, but if needed, they could certainly do that. And they're working with retailers to improve the exposure to web traffic to bridge this impulse buying gap. So they're looking at ways to bring their products forward for people who are online buying things that might create a bit of an impulse buy from a web perspective. And then lastly, they're expanding their product offerings into more health conscious product lines. They are now moving into these protein bars. They're moving into pretzels. So they are moving into less sugary product lines. So let's talk about potential upside here, because I mean, if you look at this chart, you see that they were up around the 272 range back around, looks like about May of this past year. Now they're down around 182. So, so is it reasonable to think that they would go from 182 to 272? I don't think that's reasonable. So what could be reasonable? It looks like some of our analyst friends are thinking they'll go back up as high as $213 in the next year. Some are thinking they'll be as low as $180. And so the average of that is going to be somewhere in the 198 range. So can it go up to 200? I think that's a very logical thing. I mean, that would be a 10% rise in price. I would be okay with that. And I'm looking at Hershey not to just be a quick flip. Hershey for me is going to be a core stock in my portfolio. I currently have 6 core stocks in my portfolio. Hershey now will make it the 7th core stock in the portfolio. And to get it around $182, I think is a good buy for the long-term investor. It could go down from here, and if it does, I am prepared to continue adding to the position. And if it goes up, I may have to chase it a bit. But as I was looking at where these analysts are and seeing that the low was around 180, I thought, around 182, around 180 actually, is not a bad place to enter into Hershey's. And then to top it all off, the Wall Street Journal ranks Hershey's number 29 on the Wall Street Journal's best managed companies of 2023. So can Hershey's turn this around? I think the management team has the capability. I think they've got the resources. I think they got the cash flow, and they've got the brands to make this all work. So I am buying into Hershey. If Santa brings me money, I will buy more Hershey, as long as it's down in this 180 price range. Now, anything can happen. There could be news comes out that makes us rethink all of this. But based on what we know right now, I think Hershey's is a great addition to my portfolio. It gives me another core stock in that portfolio that I plan to hold for a long, long period of time. So let me know what you think about Hershey in the comments below. Also, next week, I plan to do a year in review video. So I want to talk about all the holdings in the portfolio, what the performance was for 2023 compared to our benchmarks. And then I'll also talk about even the trades that I've done in December, which are there are quite a few. So I want to go through those. And so if you're looking for someone else's portfolio to take a look at, maybe get some ideas of what to do, maybe to get some ideas of what not to do. But either way, if that's something that you are interested in, consider subscribing to the channel so that you don't miss out. Ring that bell so you'll get a notification that this next video is coming out. I think you'll enjoy it. I'm going to enjoy putting it together. So I hope you guys have a great holiday weekend. And we've got 1 week basically left in this year, 4 market days. So we'll see what happens during those 4 market days. Have a great time with your families. Enjoy the holiday season.